Hey, it's Ben from Modern Graham, and today we are going to talk about SL Green Realty Corp. We are going to do a Modern Graham valuation and give you my thoughts on where this company is headed, so be sure to stick around. Now, what we are looking at is SLG Green Realty, okay, let me try that again. SL Green Realty Corp. Ticker SLG. The current price is $36.71, and this one is a real estate investment trust. Now, a lot of real estate investment trusts are getting slammed right now because the expectation is that the real estate market is going to have some trouble with higher mortgage rates, and that is probably true. But what we might see is that we might see a lot of these do fine. This one, these are the figures that from the balance sheet that I think are most important and will play a role in my valuation. Total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. Then when we look over here at the chart, we can see that earnings per share went up for a ways until the Great Recession hit, and then they dropped. And they've been on their way back up. They've had ups and downs along the way, and it seems that we're back down. But note that they're positive all the time, which is really good. And here we can see the details. Earnings per share diluted for the last, 20 years? Yeah, 25 years. And they're all positive. And they, like I said, they've been going up and down. This figure here in this column is earnings per share Modern Graham, which is a weighted average of the last 5 years of earnings. I take the last 5 years, I put the most weight on the most recent year, and the least weight on 5 years ago, which would be this one here. And that smooths out a little bit of the business cycle. And you can see that the earnings are pretty stable. When you have it smoothed out like that, they're between $2 and $4. Then let's look at dividends. So dividends, they have had changes, and they do respond the dividend to changes in earnings in some years and other things. In 2020, they cut the dividends presumably because of the pandemic. They actually did not take a hit on earnings, so it's a little bit surprising that they cut their dividends that year. But you can also see the dividend payout ratio has been pretty wild. Some years, the dividend payout was much higher than the earnings, which says to me that they are trying to keep that dividend as stable as they can. And that is a good thing to see, especially from a company like this, where you, like real estate investment trusts, you're really looking at the dividend, and that's what you want in your portfolio. You can see here that the dividends in red, some years have been much higher than the earnings, and other years have been lower, so that they can try to stabilize that dividend. And I think they've done a pretty good job. For the most part, I mean, they took a hit to the dividend in the Great Recession, and then for the most part, it's been pretty stable since then. So let's move on. Stage 1 is determining if the company is suitable for the defensive or enterprising investor. The defensive investor is one who is not willing to engage in a whole bunch of research into individual companies. So they have stringent requirements for who they would even consider investing in. And the defensive investor requires a company to pass 6 out of the following 7 tests. First, the market cap has to be over $2 billion. It passes that. So that is good. It just barely passes that at $2.4 billion. So it does get the point there. Current ratio has to be over 2. This one's current ratio is only 1.5, so it fails in that regard. Earnings stability, it has to have 10 years of positive earnings, and it achieves that, so it has a pass for that test. Dividend payments for 10 years prior, it passes that test. Increase in earnings per share by 33% using 3-year averages at the beginning and end. And this one has grown 72% over that 10-year period, so it passes that. PEMG, the price to earnings ratio, has to be under 20. It is 10.43 for this one, so we pass that one. Price to book ratio under 2.5. This one's price to book is 0.53. So that passes there as well. And if you've been counting along, we have 6 points, and it is suitable for the defensive investor. Enterprising investor, by default, this one is suitable for the enterprising investor because it is suitable for the defensive investor. But we'll go through it anyway. The enterprising investor is one who is willing to do more research. So they are willing to accept companies that the defensive investor might not accept. And here we have a test for current ratio. It only has to be 1.5 for the enterprising investor. So we passed that test. Debt to net current assets, it should be under 1.1. This is actually the hardest enterprising investor test for a company to pass. And this one, the debt to net current assets is 18, so it clearly fails on that score. Earnings stability, it has to have 5 years of positive earnings, and it has to pay a dividend, so it passes those two quite easily. Earnings growth, the weighted average earnings has to be greater than it was 5 years ago, and it's almost double that, so it passes there. So even if it wasn't suitable for the defensive investor, it would be suitable for the enterprising investor with 4 out of 5 passing tests. Stage 2, if you have determined that the company is suitable for your investor type, whether you're a defensive investor or an enterprising investor, the next step is to look at the intrinsic value and keep in mind that the value is separated from the price. The price is what the market is willing to pay. The value is what the company may be. And as Benjamin Graham said, I am neither right or wrong because the market agrees with me. I am right or wrong because the data supports my position. And so it's important to look at the data. Mr. Market is not always correct. And the modern Graham value formula is taken from Benjamin Graham's The Intelligent Investor book. And the only thing different is that I use the weighted average earnings. So we have value equals earnings per share times 8.5 plus 2 times the growth rate. So we have 2 variables that we have to calculate in order to be able to use this formula. First, earnings per share, as I've mentioned, is a weighted average of the last 5 years. So we look at these 5 years, and we get a earnings per share of $3.52. Plug that here into calculating the value. And the growth rate, we look at the current earnings per share and the one from 5 years ago. We take the total growth between those two figures, and we get 47.12. And then we take the average growth of that. Take 47 divided by 5, and you get 9.42%. Then we put in a safety margin because growth is a huge variable in this formula. If you have your growth rate off, it can make a huge impact on your value output. So we put the safety margin in there just to have an added level of cushion in terms of making sure that we have that margin of safety. Using those figures, we come to a modern Graham value of 79.68, which with this very handy chart over here, you can tell that the value is much higher than the current price. Therefore, it is given an undervalued rating. Moving on, we can see that we have a few other figures here. Net current asset value, we'll talk more about in a minute. That is a floor to your value, and it is above that, so that doesn't matter here. Modern Graham value based on 3% growth. If you put 3% here and then use the weighted average, you get a value of 51.05, which is also still higher than the current price. So even if it only grows at 3% instead of the 7%, you still have an undervalued price. Based on 0% growth, the market, where it would be worth $29.92. So that indicates that the market is implying a positive growth rate. And here you can see that if we put the price in for value in our formula and then solve for growth, that is the implied growth rate that we see the market giving right now. And so that is saying that the market believes this company will grow in perpetuity by just under 1% per year. If you agree with that, then you would think that the price is fairly valued. If you think that that is low, then it would be another indicator that this is an undervalued company. Down here we have the modern Graham grade. This one gets 2 points for being suitable for the defensive investor. It gets 1 point for being undervalued. It is not trading below its Graham number, which we'll talk more about in a moment. It is not a long-term dividend growth. It does have a dividend yield above 2%, and its PE ratio is below the industry average. So overall, it gets 4 points, which on our scale gives it a B+ grade. Stage 3. So if you are at this point and you've determined that it's suitable for your investor type and it is undervalued, which is what I just said that it is, then you would need to engage in further research to determine if the company is suitable for your particular portfolio. I can't tell you if it is or not. You need to decide that for yourself. Net current asset value, like I said, that is a liquidation value. If the company took its current cash and paid off all of its liabilities, this is what would be left. And in this case, it's negative. In rare situations, it might be positive. So it might be a situation where investors could go in and say, hey, we're buying the company. We're going to just take the cash and pay off all of the total liabilities and then keep what's left. If your net current asset value is higher than your price, then that is a really golden opportunity there. Graham number formula is derived from the defensive investor requirements in the intelligent investor, and that results in a value of 34.45, which is pretty close to the current price. That is a number that a lot of people do use to consider whether or not a company is undervalued, and you may choose to do that yourself too. PEMG formula, as I mentioned, the PEMG, the price to earnings modern gram, the price over the earnings per share modern gram, that weighted average, comes to 10.43. Then other useful information you might want to consider for this company: the current ratio is 1.51, price to book is 0.53, the dividend yield is 10%, and it has had 2 years of consecutive dividend growth. If there's anything you want on this stage that you want me to talk about, please leave a comment below and tell me what information would be useful for you in your research. Moving on to stage 4. Now that we have determined that it is suitable for your portfolio, or if you've determined that, then the next thing would be to try to find the right time to buy, because we want to try to maximize what we earn. And while the market does not determine the value, the market does play a role in how much profit you make. So it is useful to study the chart and figure out when might be a good time to buy. And looking at this chart, we can see that, like many companies, this year it has been on a downward trend. It came down. Then it hit this point at about 44 or 45, which was a level of support from from 2020 is when it hit that support. It came back, it hit that and bounced back up and broke through that trend line. Then it couldn't quite make it all the way up. It hit something here, the upper end of that line here. And when it hit that, it came back down, and it has now kind of established a new trend line that it's following down. I've made another line here, which would be an indicator that if it can come back up and cross that mark here at about 40, then it might be on its way back up, or it might be settling into, a zigzag pattern here. Right now, it is on a downward trend. We had a high here, then a lower low, a lower high, lower low, lower high, lower low, lower high, and now it's probably on its way down past this low here. But it is one to watch, and as I mentioned, it is undervalued. Down here you can see the RSI indicator, which is the purple line, and the blue and red line are moving averages, which is something that I use to indicate where it's moving in that RSI. If it gets down here, below this 30 point, then it might be ready for a turnaround. It might be oversold. If it gets down below 20, then it really is oversold. And you can see that happened here. It sold off very quickly. It came down here in the chart, and then it kind of stabled off. So you could tell that it was probably about done dropping. but the price has not come back up. It did rise in there. But the other thing to watch is it has not broken above 70 for a long time. So that indicates that it is in a bear trend. And at some point, if it were to break above 70, that would indicate that it is now starting to be in a bull trend. And that would be another indicator that it might be time to buy. But anyway, click on the video on the screen now. That is a list of more high yield dividend stocks that you might be interested in. This was one of them on the list, and those are more. So click on that video, and I will catch you next time. Take care.